global fixed income market registered a strong rally after G3 central banks reiterated the risk of slowing growth, which will require additional monetary stimulus in the near future. Investors are now pricing in 3 rate cuts for 2019 by the Fed, which is a drastic change from last year's 3 rate hikes this time around. The ECB has also announced that it will resume bond purchases in the fourth quarter of 2019, as well as cutting its interest rates to negative 0.5%, rendering itself to be the first central bank to be operating an unrestrained quantitative easing policy, or entering into an era of what we call SQ-finity. Emerging markets are also lowering their interest rates to counter the slowing global growth, which includes countries like Thailand and Indonesia. Interest rates have been the forefront policy tool to cushion economic slowdown, largely because of the frequency of the policy being discussed, as well as the decision-making process, which typically excludes the need for political bipartisan agreement. Having said that, this policy has been carrying much of the weight to spur economic recovery. As a result, 30% of investment-grade bonds are now yielding negative numbers. It is becoming increasingly more difficult for the banking and finance industry to manage margins and risk. With limited space for monetary policy, fiscal policy would have to increase its influence to spur economic recovery. While fiscal policy could contribute more in terms of restarting growth momentum, it is important for us to note that it was only 10 years ago the EU encountered its first problem when several of its member countries had to be bailed out due to high levels of government debt. Like a car, fiscal and monetary policy has and will always be the suspension system that will weather the economy when it goes through rough terrain. The very design of the car is the one that determines how far and how fast it can go. And this design, it is like the policy that the government chooses to enact in order to shape the competitiveness of its own economy. Coming back to the bond market, central banks will likely remain dovish, with rate cuts varying from country to country depending on economic conditions and design. Despite conditions still being accommodative, the bond market has rallied significantly in 2019, and investors might be thinking of profit-taking in quarter 4 and reassessing their strategy for 2020. In this case, we are recommending a more neutral to lower duration strategy for the remaining parts of 2019, with a view to increase duration upon a correction. Key events to keep an eye on will be Brexit, US-China trade negotiations, and also US consumer confidence. Emerging economies such as those in Asia, and in particular ASEAN, will probably stand out as bright spots given its stronger fundamentals relative to its peers.